Hey there folks, welcome to my channel, and today we're diving into the thrilling world of, wait for it, repo and reverse repo. Don't worry, I promise it's more exciting than it sounds. Imagine these as the cool kids in the financial system, the ones who keep the money flowing and the economy humming. Central banks, like the Federal Reserve in the US, use these tools to manage how much money is sloshing around. Too much money, inflation goes nuts. Not enough, the economy stalls like a rusty car. Repo and reverse repo are like the gas pedal and brakes, helping to keep things running smoothly. So, buckle up as we break down these financial instruments into bite-sized pieces. Even your Uncle Jerry could understand. No offense to Uncle Jerry, of course. Let's start with repo, short for Repurchase Agreement. Think of it like a short-term loan, but instead of your beat-up van, banks use government securities as collateral. Here's the deal. A bank needs some quick cash. They go to the central bank and say, hey, can I borrow some money? I'll give you these shiny government bonds as collateral. The central bank says, sure thing, but you've got to buy them back from me in a few days with a little interest on top. That interest, my friends, is the repo rate. Now, here's where it gets interesting. If the central bank wants to slow down inflation, they'll raise the repo rate. This makes borrowing more expensive, so banks are less likely to lend money and there's less cash floating around. On the flip side, if they want to boost the economy, they'll lower the repo rate, making borrowing cheaper and encouraging more lending. It's all a delicate balancing act, like trying to walk a tightrope with a stack of pancakes in your hands. Now let's flip the script and talk about reverse repo. As you might have guessed, it's basically the opposite of repo. In this scenario, the central bank is the one borrowing money from commercial banks. They sell government securities to the banks with an agreement to buy them back later at a slightly higher price. The interest the banks earn on this deal is called the reverse repo rate. Why would the central bank do this? Well, imagine there's a bit too much cash sloshing around the economy, threatening to push up inflation. By raising the reverse repo rate, they can incentivize banks to park their excess cash with the central bank, effectively taking some money out of circulation and keeping inflation in check. It's like when your dog buries a bone in the backyard. The bone is still there, but it's not causing any trouble for the moment. So, there you have it, repo and reverse repo in a nutshell. To recap, repo is like a short-term loan from the central bank to commercial banks, while reverse repo is the other way around. Both tools help the central bank control the money supply and keep the economy on an even keel. Think of it like this. Repo is like adding fuel to the economic engine, while reverse repo is like tapping the brakes. By carefully adjusting these levers, central banks can steer the economy in the right direction, hopefully avoiding any major crashes or explosions along the way. And that, my friends, is the thrilling world of repo and reverse repo. Who knew managing money could be so exciting? Until next time, subscribe and stay tuned.